Good morning. It's Tuesday, March 14th. And a terrible thing happened a few days ago. The Silicon Valley Bank failed. And on top of that, the Signature Bank in New York was closed for similar reasons. Now, what is a bank failure? When they talk about a bank failure, most of us really don't understand what that really means. The bank failure is the closing of an insolvent bank by a federal or state regulator, right? And that means that the bank is unable to meet their obligations to their depositors and other people's. And when a bank fails, the Federal Deposit Insurance Corporation, the FDIC, covers the insured portion of depositors' balance, including money market accounts. So normally when a bank fails, money is paid out to the accounts up to the value of $250,000. But that's not what's going to happen in this particular case. In this particular case, Biden and the government have stepped in and said they will honor the total amount for every depositor at these two banks, Silicon Valley and Signature. And that's an unusual step, because could you imagine what would really happen if they went strictly by the FDIC rules, where if you had more than $250,000 in the bank, you lost the portion of the money because they're only covering $250,000. But Biden has stepped in and has guaranteed the payment. Now, this is the first time we really had a major bank failure since 2008. Now, bank failures are difficult to predict, and the FDIC does not announce when a bank is set to be sold or going under. And it may take months or years to reclaim uninsured deposits from a failed bank if the government didn't step in like they did. So imagine if you had money in that bank and it failed and you couldn't get all your money. That could be a hardship for individuals as well as corporations. And one of the factors that contributed to this failure of Silicon Valley is that they own bonds, right? And many banks own bonds, and Signature probably own bonds too. So you buy bonds at a certain interest rate, but in this inflationary environment where the interest rates kept going up and up and up, the bonds that you bought become less valuable. So if you had $1 million in bonds because of the old interest rate, those bonds might only be worth $800,000 now. So the banks are in a tenuous position, because if they lose money, then that affects the money that they can hand out to their depositors. So it's a very dicey situation in the banking business. So in simple terms, the most common cause of bank failure occurs when the value of the bank's assets, those are your bonds and everything, falls below the market value of the bank's liabilities, which are the obligations to the creditors and the depositors. And this might happen because the bank loses too much on its investments. And that's probably what happened in Silicon Valley, because it's not possible to always predict when a bank will fail. But if they've got a bunch of bonds and they're not getting the right interest rate, that could cause a bank failure. Now, I'm not sure if that exactly happened in Silicon Valley. Now, the largest bank failure of all time was during the 2007 and 2008 financial crisis, when the Washington Mutual, which had $307 billion in assets, closed its doors. And another large bank failure a few months earlier than Washington Mutual was the Indy Mac, and that was the second all-time at $34 billion. So there's a big difference between $307 billion and $34 billion in the failures. And I'm not sure what the amount is on Silicon Valley, but they said Silicon Valley is now the second one, second in size to the Washington Mutual. So bank failures are not a good thing. And the FDIC, which is the Federal Deposit Insurance Company, well, they were formed in 1933. They were part of the New Deal, you know. So if we look at what was going on at that time, I'm talking around 1933, During the first 10 months of the Great Depression, 744 banks failed. And during 1933 alone, about 4,000 American banks failed. Think about that. 4,000 banks failed. And by the time the FDIC was created, American depositors had lost about $140 billion due to bank failures. Now that $140 billion might be $1 trillion in this day and age, or maybe it's $2 trillion in this day and age. Because in those days there was no FDIC to protect them. There was nothing protecting your bank depositors. Bank customers were screwed back in the 1930s. They had no way to get their money back. But now we have the FDIC, and in addition to the FDIC, we have a president who has stepped forward and guaranteed every depositor in these two banks, Signature and Silicon Valley, that they will get every penny of their money back. Now that's an unheard of proposition, and I'm waiting to hear what the opposition parties have to say about that. So far, I haven't heard anything from the Republicans with this situation. But knowing how tight they are, maybe they're willing to step forward and say, let's not give anybody over $250,000 their money back. But they won't say that, because that particular group of people, the wealthy, I will consider anybody that has over $250,000 in the bank wealthy, the wealthy are linked to the Republicans in some way, shape, or form. Even if it's not true, but mentally they believe it's true. So I don't think there'll be a big hullabaloo about what Biden is doing with respect to the banks. Making sure that all the customers get their money back. Good thing. But something else is lurking in the back of my mind. Given the fact that these two banks failed, is it not possible that there are other banks around the country in similar situations? If these banks are buying bonds at some interest rate, and the interest rate keeps going up, the value of those bonds gets much lower. So I wouldn't be surprised if we don't have a few more banks fail in the coming weeks. It's an interesting thing to keep an eye on, because I don't believe that this thing is happening in a vacuum. I think there will be other banks that are on the edge right now. And it's due to the whole economic structure that has occurred from the inflationary period that is going on right now. So I leave you with that this morning. A good deed following a disaster. Have a great day. Bye.